$34,000. That's what you had on February 19th, 2020. The market is at an all-time high. Your portfolio is solidly green, has been green for 11 months straight. You are 28 years old, and you feel like you finally understand this. You don't. US markets are still trading near all-time highs. Nobody is scared. The news is talking about the virus, but it's over there, someone else's problem. You check your brokerage app while you're eating breakfast. You feel good. You close it. Then, in 1 month, the S&P 500 falls 34% from its peak. Not gradually, not politely. It falls like something broke. It was the fastest correction in market history from an all-time high. 6 days to enter correction territory. 6. You check your phone and the number is wrong. You check it again. Still wrong. The speed of the drop made it feel less like math and more like chaos. Your $34,000 is now worth $22,400. You haven't sold anything, but it feels like someone reached into your account and took $11,600 out while you were asleep. That's what it feels like. Not abstract, not theoretical. Gone. The CBOE Volatility Index, the VIX, surpasses 80. Its highest reading since the 2008 financial crisis. It's the market's fear gauge, and it is screaming. The news is worse. The headlines are worse. Every morning you wake up and check the number. Every morning the number is lower than you expected. Market downturns receive intense media attention. Headlines use dramatic phrases. Continuous exposure to negative news increases anxiety and reinforces the perception that immediate action is necessary. You feel that. You feel it in your chest at 6:47 a.m. You feel it when someone mentions the economy at dinner. You feel it when you try to sleep and can't. Fear becomes a rhythm in your day, echoing louder than the numbers themselves. The first rule: fear feels like information. It isn't. Fear during a crash is not your body telling you to act. It's your body telling you something is happening. Those are not the same thing. Acting on fear during a crash is the most expensive mistake you will ever make, and it will feel completely rational when you make it. Human behavior studies show that we feel the pain of losses twice as strongly as the joy of gains. A psychological principle called loss aversion. So when your portfolio drops $11,600, it doesn't feel like an $11,600 loss. It feels like a $23,000 loss. Your brain is lying to you, not maliciously, evolutionarily. Your brain was built to avoid immediate threats. A bear market is not a bear, but your nervous system doesn't know that. March 12, 2020, Black Thursday, a global stock market crash. U.S. stock markets suffer the greatest single-day percentage fall since the 1987 stock market crash. You open your app. You stare at the number. Your $34,000 is now $20,100. You think about selling. You think about it seriously. You sit with it for 40 minutes. You draft the sell order. You don't submit it. Not because you're brave, because you're frozen. Sometimes the inability to act is the only thing that saves you. This is the moment, not the dramatic one, the frozen one. An investor who sold on March 23rd locked in a 34% loss. And watched the S&P 500 post 18% gains for the full year. They made the rational decision, the one that felt right, the one that felt like protection. And it cost them everything that came next. The shift in mindset. You stop thinking about the crash as something happening to you and start thinking about it as something happening around you, externally. The market is not your enemy. It is a machine. And right now the machine is on sale. You are 28 years old. You have $20,100 remaining. And somewhere in the back of your mind, a thought appears that you're almost quietly embarrassed to have. What if this is the exact moment? You start reading. Not headlines. Not Twitter, actual reliable data. The stock market has recovered from every single bear market in the past 150 years, on average about one a decade, and every time it went on to new, all-time highs. Every time. Not most of the time. Every time. Market crashes always feel deeply terrifying when they happen, but there's no way to know in the moment whether you're encountering a minor correction or looking down the barrel of the next Great Depression collapse. You know this. You hold that thought and you sit with it. And then you do something that will take you years to fully understand and process. You transfer $14,000 from your savings account into your investment brokerage. It is March 16th, 2020, and the Dow just fell nearly 3,000 points in a single day. The largest one-day point decline ever at that time. You are buying into the financial worst week in modern market history. Your hands are not steady at all when you place the order. In moments like this, logic and emotion stop aligning, and only discipline is left. The second rule: the best time to invest almost never feels like the best time to invest. It feels like a clear mistake. It feels irresponsible. It feels like you are doing something wrong in public. The feeling of confidence and the feeling of correctness almost never arrive at the same moment. If you wait to feel confident and certain before you act, you will always be too late. March 23, 2020. The S&P 500 closes at 2,237, a 34% plunge from its February 19th peak. The fastest bear market entry on record. You check your portfolio. Your combined position, the original $34,000 and the $14,000 you added, is now worth about $28,700. You are down $19,300 from where you started. You do not sell. You go for a walk. You come back. You do not sell. 76% of the stock market's best days have occurred during a bear market or during the first 2 months of a bull market. You don't know this yet. You will know it later. What you know right now is that the market has crashed 34% in 33 days, and you just put $14,000 into it, and your stomach still hurts. March 24th. The market bounces 9.4% in a one day. Your portfolio goes from $28,700 to $31,400 overnight. One day. You stare at it. You don't trust it. Many of the best days take place shortly after the worst days. In 2020, the second best day fell right after the second worst day that year. The chaos is not random. The volatility cuts in both directions. The people who sold on March 23rd didn't just miss the recovery. They missed the single best trading days in a decade, which arrived without warning in the middle of the panic. The market hides recovery inside fear. The third rule: you cannot capture the recovery if you are not present for it. Selling during a crash doesn't protect you. It locks in your loss and removes you from the only thing that actually fixes it. The recovery is not a reward for the brave. It's a result of staying. April arrives. The market is up, then down, then up again. After the initial shock and the massive losses, the markets begin to recover. This recovery is supported by the rapid and decisive response by governments and central banks. The Federal Reserve cuts rates. Stimulus packages are announced. You don't understand all of it. You just watch the number move. By early April, your portfolio is at $33,200. You are almost back to the start, on $34,000 of original capital. With $14,000 of fresh money added at the bottom, you are nearly even on the original position and sitting on a paper gain. You are 28 years old, and you are starting to understand something that most people will spend their entire lives avoiding. By August 2020, markets regained pre-COVID levels. Your portfolio crosses $54,000. You check it on a Tuesday morning before a meeting. You almost say something out loud. You don't. Because you don't know how to explain to anyone what just happened without sounding lucky. Maybe you did. Maybe luck and discipline look similar from the outside. The shift. You stop checking your portfolio to see how you feel. You start checking it the way you check the weather. Information, not identity. By 2021, many indices hit new all-time highs. Your portfolio is at $71,000. You are 29. You have never had 5 figures before the crash. Now you have 6. The number doesn't feel real. You keep waiting for something to take it back. Nothing does. You start adding every month, not because you feel confident, because you understand now that confidence is not a prerequisite. Discipline is. You set up automatic contributions, $800 a month. You pretend it isn't there. You do not check it every day anymore. This is harder than it sounds. Discipline feels harder than confidence, but it lasts longer. The fourth rule: the investor who checks their portfolio daily is not more informed than the investor who checks it monthly. They are more emotional. Frequency of checking is not a signal of seriousness. It is a signal of anxiety, and anxiety is costly. The 2022 bear market quietly erases more than $8 trillion in equity value, before bouncing back to new highs within 21 months. Your portfolio drops from $71,000 to $53,000. You are 30. You have been through this before, not theoretically, actually. You know what a crash feels like from the inside. You know what the headlines sound like. You know that the feeling of certainty that it will keep falling is not information, it is noise. You add $800 in January 2022. You add $800 in February. You add $800 in March, while everyone around you is talking about the end of the bull market, the death of growth stocks, the new era of rising rates. The 2022 stock market crash was different from the others in one important way. It wasn't caused by a financial crisis or a sudden external shock. The Federal Reserve engineered it deliberately. Inflation hit 9.1% in June 2022, the highest since 1981. The Fed raised interest rates 11 times in 18 months. You keep adding. You are not fearless. You are trained. A $10,000 investment in the market fell to $8,183 by year-end 2022. Then recovered and reached $12,897 by end of 2024. The investor who sold at year-end 2022 locked in a $1,817 loss and sat out back-to-back 25% plus years. You don't sell. You have seen this before. You were there in March 2020. You know what the bottom looks like from the inside. It looks exactly like this. Scary, rational sounding, full of people who seem very certain that it will get worse. The bottom always feels convincing until it isn't. The fifth rule: every crash sounds different and feels the same. The headlines shift, the cause varies, the language changes, the psychology doesn't. Fear is fear. The market doesn't care what year it is or what the reason is. It goes down, then it comes back. The only variable is whether you are still there when it does. By missing just 10 of the market's best days over a 20-year period, the sideline investor made a 5.33% return each year on average, instead of a 9.52% return that a buy-and-hold investor made. That difference sounds small. It isn't. On $100,000 over 20 years, that difference is the gap between $620,000 and $250,000. The same starting point, the same years, different decisions about when to be present. Small percentages create massive gaps over time. If you missed the market's 10 best days over the past 30 years, your returns would have been cut in half. And those 10 best days? Over the last 20 years, 7 of the 10 best days happened when the market was in bear market territory. Not during the calm, not during the confidence, during the fear. During the exact moment when every instinct you have is screaming at you to get out. You are 32. Your portfolio is at $118,000. You did not inherit this. You did not get lucky with a startup. You did not pick the right stock at the right time. You simply stayed. Through 2 crashes, through the frozen mornings, through the moments when selling felt like the only sane option. You stayed. The shift. You stop measuring your wealth by what the number is today. You start measuring it by what it will be if you do nothing for the next 10 years. The number today is almost irrelevant. The behavior today is everything. If you had invested $10,000 in the S&P 500 and left it untouched for 20 years, your investment would have grown to $64,844. You are not untouched. You added. You compounded. You didn't time anything. You just refused to walk away. This is where discipline begins to outweigh luck. You are 36. The portfolio is at $214,000. You remember the $34,000. You remember checking it at 6:47 a.m. on a Tuesday in March 2020, watching it fall in real time, drafting the sell order. You remember the frozen feeling. You remember that the thing that saved you wasn't courage, it was paralysis. And then later, understanding. And then later still, steady discipline. When you incorporate the effect of inflation, $1 invested in a hypothetical U.S. stock market index in 1871 would have grown to $35,082 by the end of February 2026. $1. 155 years.
Through 2 world wars, the Great Depression, the dot-com crash, the 2008 financial crisis, a global pandemic, and a Fed-engineered bear market. $1. Now worth $35,082. The machine doesn't stop. It doesn't care about the news. It doesn't care about how you feel. It opens every morning. It takes whoever shows up. The sixth rule. The market is not a casino and it is not a savings account. It is a machine that converts time and patience into wealth. The inputs are simple. The execution is the hardest thing most people will ever attempt. Not because it requires intelligence. Because it requires sitting still, while everything in your body is telling you to move. Wealth is built by waiting when it feels hardest to wait. You are 28 years old. It is February 19, 2020. You have $34,000. The market is at an all-time high. You feel like you finally understand how this works. You don't. Not yet. In 33 days, everything will fall. The fastest correction in market history from an all-time high. And somewhere on March 16, 2020, with shaking hands and a stomach full of dread, you will place a buy order into the worst week in modern market history. And it will be the best financial decision of your life. Not because you knew. You didn't know. Nobody knew. It's impossible to predict how long a stock market recovery will take. But you stayed. You added. You showed up. And the machine, which does not ask whether you are ready, which does not check whether you are scared, which opens every morning regardless of what you are feeling, the machine rewarded your persistence. The reward was not luck, it was the consequence of staying. It always has. It always will. The machine doesn't ask if you're ready. It opens every morning. Your portfolio was $34,000. It always starts there. It always will.